Section 14.3 is on promissory notes. We have three objectives. You need to be able to record the acceptance of a note receivable. You need to be able to account for the collection of a note receivable, and you need to be able to account for a dishonored note receivable. So first, they're just giving us a bunch of terms and definitions. So first of all, a promissory note is a written and signed promise to pay a sum of money at a specified time. The business or the person to whom the liability is owed is called the creditor. The promissory note signed by a business and given to a creditor is entered in the business's books as a note payable. A promissory note that a business accepts from a customer is entered in the business's books as a note receivable. So it just depends as to what end we are on with that promissory note, as if we record it as a note payable or a note receivable. So if we're recording it as a note payable, that means that we signed the note and gave it to the creditor that we owe money to. If we're recording it as a notes receivable, that means that we accepted it from a customer that owes us money. Okay. Notes payable and notes receivable are frequently referred to simply as just notes. Okay? The maker of a note is the person or business that signs a note and thus promises to make a payment. So the creditor is the person that is owed the liability, and the maker of the note is the business or person that signs the note. More terms. A payee is the person or business to whom the amount of a note is payable. The principal is the original amount of a note, sometimes referred to as the face amount. Interest rate is the percent of the principal that is due for the use of the funds secured by a note. Maturity date is the date on which the principal of a note is due to be repaid. And then the time of the note, or the term, it could be called, is the length of time from the signing date to the maturity date. It's usually expressed as a number of days. All right, so here's an example of a promissory note. We see that we have the date up here. We have the number for the note, name and address. Here's our term. Here's our principal amount. Here's the interest rate. Here is the maturity date. And then here is the signee and a witness, or there's two witnesses here to the signing of that note. All right, so on March 18th, we accepted a 90-day 8% note from Skinner College for an extension of time on its account, $2,578.35, note receivable number 6. So what's happening here is that Skinner College is not able to pay us in the previous time that they had said that they would pay us. And so now they are doing a promissory note, just promising that they are going to pay us. And so we are accepting that note. So we're giving them 90 more days, and now we're charging them an interest rate of 8%, and then this is the principal amount. So what we're going to do is we're going to put that amount into our notes receivable. Okay, so we're going to debit notes receivable, we're going to debit, and we're going to increase notes receivable. And then we're going to credit accounts receivable. Really what we're doing is we're transferring that money or that amount from the accounts receivable. They owed us this. We're transferring it from accounts receivable into notes receivable. And then we also need to get rid of it from Skinner College. So we're also going to credit Skinner College and decrease what they owed us, okay? Because we're transferring it from that accounts receivable into a notes receivable. So this is going to go into our general journal. We're going to put in our date. We're going to debit notes receivable. There's our document number, our debit amount, and then we're going to credit accounts receivable / Skinner College. Remember that slash goes into the post reference column to show that we would be posting that credit to two separate accounts. And then we have our credit. Now, interest is the amount paid for the use of money for a period of time. And to figure out our interest, we're going to take principal times the annual interest rate times time as fraction of the year. And that will give us then the interest for the fraction of the year. So the reason that we're doing this part in here is when we look at this 8% interest rate, this 8% is for a full year. Well, they're not paying for a full year. They're only paying for 90 days. And so that's why we're going to take this as a fraction of the year. For easy math, we're going to use that year as instead of 365 days, we're going to use 360. Okay, so we're going to use 90 over 360. So our principal amount times the interest rate of 8% times that fraction, 90 over 360, and then this gives us that interest of $51.57. The amount that is due on the maturity date of a note then would be called the maturity value. To figure out the maturity value, we would take the principal plus the interest to get that value. Okay, so here we're showing the principal, the interest that we just figured out, and now here is the maturity value. Now, the next part is we're going to have to figure out the maturity date. So they're not going to just tell us the maturity date. We're going to have to figure this out. So this is where we really need to make sure that we know how many days are in a month. They've set this up into a table, which works really nice. What we're looking at here is that we have a 90-day note. So we're going to put days remaining over in this right-hand column. Okay. We signed or we received the note on March 18th. So we're going to do subtraction here because we know that there are 31 days in March and it was signed on the 18th. So we're going to take 31 minus 18 and that gives us 13 days. So that's showing that we're going to use 13 days in March. Okay. Now we're going to subtract to figure out how many days we have remaining to figure out. So we have 90 days. We used 13 in March. Now we have 77 days left. Okay, next we're going to look at April. There are 30 days in April. We're going to use all 30 days into our maturity date. Okay, so we're going to take 77 minus 30. Now we have 47 days left. Now we're looking at May. May has 31 days. Okay, same thing. We're going to take 47 minus 31. We're using all of those 31 days. We have 16 days remaining. Now, when we look at June, we're not going to use all of June because we only have 16 days left. So here they're just showing June 1st through the 16th. We're going to use 16 days in June, and so our days remaining would be 0. When a note receivable reaches its maturity date, the maker of the note is expected to pay the maturity value then to the payee. Interest income is the interest earned on the money that is loaned. The interest earned on a note receivable is credited to a revenue account titled interest income. I don't know if you can hear Becca in the background. Sorry if you can. Okay, so here we're seeing this transaction on June 16th. Remember, this is the maturity date that we just figured out, June 16th. We received cash for the maturity value of note receivable number 6, a 90-day 8% note, principal amount, interest amount, and then total amount receipt number 780. So first thing that we're going to do is we're going to debit cash because we're receiving cash and we are receiving cash in the total amount. This is our total amount. Okay, so debit cash. Then we're going to credit notes receivable for the principal amount. So this is what we were owed for that note. Okay, so we're going to credit notes receivable. This is what we are owed. And then the last part we have is this interest. Now, this interest is money that we're actually making. We were only owed this much, but because of that note and that interest that we charged, we made money of $51.50, 57 cents, sorry. And so we need to record that as a revenue. And so the account interest income is what we're going to use for our revenue account. Now, when we add up our 2 credits, that will equal our 1 debit. So we're going to put this into our cash receipts journal because we are receiving cash. Start with our date. We're debiting notes receivable, or sorry, not debiting, we are crediting notes receivable. We have our document number, we have our credit to notes receivable, we have our credit to interest income, and then we have our debit to cash. Now, a note that is not paid when it is due is called a dishonored note. And so we have to know, just like uncollectible accounts, we have to realize that there are going to be times that we're going to have a dishonored note that people aren't going to pay. Excuse me. So on June 3rd, Stout Company dishonored note receivable number 4, a 60-day 8% note, maturity value due today, principal 3,000, interest 40, for a total of 3,040, memorandum number 98. So what we're saying here is that Stout Company was supposed to pay us today for their note. They did not pay us. Okay, so that is considered a dishonored note. What we're going to do is, remember initially when we got that note, we had moved it from accounts receivable to notes receivable. Now we're going to do the exact opposite. We're going to take it from notes receivable, and now we're going to move it to accounts receivable, showing that they owe us money in their account. So we're going to debit accounts receivable for the total amount that they owe us, including that interest. We're going to credit notes receivable, so we're getting rid of that notes receivable for the principal amount. And then we're also going to, this should not say notes receivable, that should say interest income. We're going to credit that interest income. Now, we're not actually receiving that money, but we have earned that revenue. So we are going to credit interest income. And then we're also going to debit, with that accounts receivable, we're going to debit Stout Company, showing that they owe us money. Okay, so here's how it's going to look. We're going to put this into our general journal. So we're going to start with our date. We're going to debit accounts receivable, Stout Company, memorandum 98, and then this is where we'll have a slash again because we'll be posting that debit to accounts receivable and to Stout Company. Then we're going to credit notes receivable for the principal amount, and we're going to credit interest income for the interest amount that they owe us. All right, number 1, what conditions might cause a business to delay payment to a vendor? So a receipt of cash from sales does not occur at the same time and in amounts sufficient to pay for needed purchases and expenses. Number 2, what is the advantage of a promissory note over an account receivable? So with a promissory note, this can be a lot more useful in court of law because this then is evidence of a debt, okay, written evidence that we will have. Number 3, what does an interest rate of 10% mean? That means 10 cents will be paid for the use of each dollar borrowed for a full year. Remember, those interest rates are for a full year. Number 4, what is written in a customer's account when 1, a note is accepted, and 2, a note is dishonored? So for 1, when a note is accepted, we would actually write accepted note in the item column of the customer's account. And then 2, a note that's dishonored, we would write dishonored note. Same thing like we were talking about for 14.2. If we're writing off an account and then reopening an account, we want to put that in our item column to make sure that we're understanding what's actually going on in those accounts. Okay, that's the end of 14.3 lecture. You can now go to the 14.3 work together video.